Um, Good morning or good afternoon, depending on where you are today. My name is Matt San Regret. I'm Vice President of Sales here at Payroll Systems, and I just want to say a quick welcome. I have with me Todd Balistri here. He's the President of Nimble Reporting. Todd's going to be our guest today. Thanks again to you, Todd, for joining us to talk about one of your favorite topics. All right. Wanted to point out a few things. First of all, absolutely want to encourage questions and answers. Please bring your questions. We have a great QA feature as part of the software. We can be monitoring those throughout the presentation. If it makes sense to interrupt, we would certainly do that. If it makes sense to push those to the end of the presentation, we're going to do that as well. If we want to follow up by email, and that might make more sense, we can do that. So again, let's make this interactive. At the end of the presentation, we'll also post both Payroll Systems contact information as well as Nimble Reporting. If anybody wants to continue the conversation going forward, we would welcome that. So again, I think we got top of the hour. In the interest of everybody's time, let's kick it off here. Let me introduce Payroll Systems first. So once again, I'm Matt San Regret, Vice President of Sales here at Payroll Systems. For those of you not familiar with Payroll Systems, we've been a leader in certainly payroll, as well as all facets of HR technology, including benefit administration and consumer-directed healthcare plan administration, ACA administration, for over 30 years now. We're located in the San Francisco Bay Area. We service clients throughout the country. We have clients as small as 1 employee and as large as 1,000 employees. So if that fits your category, welcome. Again, our topic today, ACA reporting for 2021. It appears ACA is going to be here for the next little bit. We try to do a webinar on this topic at least once a year. I think 3-4 years ago, there was concern over, oh, do I really need to worry about that? It's probably going to go away next year anyway. And it looks like that's not the case. So again, we want to keep this top of mind. We want to keep everybody up to speed on what's going on. So this webinar can act as a refresher for those already familiar, you ACA veterans and experts out there over the last 5-6 years, however much you can become an expert with the different changes going on. And it's also great for folks just getting started. If you're just new to ACA, this might be your first year reporting, or you're just finishing up your 2020 reporting. Welcome, and this is for you as well. So, Todd, let's jump to you. I'm really pleased to introduce our guest speaker today. That's Todd Balistri. So you see Todd there, and here's his bio. Todd's President and CEO of Nimble Reporting. They specialize in working with corporate and executive clients. Todd's a frequent lecturer on employee benefit programs and is presented at various national and regional business and accounting organizations. Nimble Reporting offers a cloud-based technology to help companies stay compliant with ACA reporting. We're going to actually give you a little sneak preview of the Nimble platform today for those of you not familiar with it. The idea is that using a cloud-based platform for just maybe minutes every month, it eliminates what was affectionately known a few years ago as ACA season, which hopefully not too many of you are in right now, where it would be weeks of time in January, maybe into February, as deadlines got pushed out, to frantically go through your paperwork from the previous year, working with spreadsheets, working with manual reports to try to pull things together to get your ACA done. So again, Todd, thank you so much for joining us, taking time out of your busy day.
Oh, indeed. Matt, thank you. And Payroll Systems is a wonderful partner. We're happy to be here again.
Right on. Well, let me run through the agenda, then I'll turn it over to you and we can get this show kicked off. So first of all, we're going to start with a quick history of ACA. And it is relatively quick history. Even all things being said, it's only really been around for 6, 7, 8 years. So even for you veterans, you're not so much veterans. We want to talk about what events led us to where we are today. Then we're going to move on cover the basics again of what exactly are the ACA reporting requirements, the tracking and reporting requirements. We're going to cover what the IRS is doing to enforce compliance and how to avoid, how to stay in compliance and avoid penalties of them. And finally, we're going to talk about very familiar challenges that any employer faces that's dealing with ACA tracking and reporting, and talk about some best practices you can adopt right away. So with that, I'm going to probably dim my camera, Todd, and I'll turn it over to you to start the presentation.
Excellent. Thank you, Matt. I will turn off the camera as well, and let's jump right in. And why don't we start with ACA and the court challenges, which have really been going on. It's remarkable for those of you that have been sticking with ACA, as Matt says, maybe some of you are experts at this point. The law, and it's remarkable to think about this, the law was actually signed by President Obama in March of 2010. So here we are 11 years after the law was signed. It seems like just yesterday. And if you maybe you don't, the first provisions of the law actually went into effect in September of that year, September of 10. And the first of 3 challenges to the ACA occurred a couple of years after the law was signed, and that was in 2012. A challenge to the ACA made its way up through the courts and eventually landed at the Supreme Court. And the Supreme Court made a decision at that point that any provisions which had already been rolled out up till that point, and all of the provisions which are expected to continue to be rolled out beyond 2012 are perfectly fine, legal, and we are not going to interfere. So that was the first challenge. The ACA passed that test, if you will. And then we had 5 years later, shortly after the 2016 presidential election, we had an effort in early of 2017 to repeal and replace. You may recall this was really the drumbeat. If you watch the news, it was repeal and replace for months and months going into 2017. And the Republicans did have a chance to repeal the ACA. In fact, there was a House bill which passed the House and was being contemplated by the Senate at that time. And famously, you may remember the late Senator John McCain with his thumbs down, which was a big to-do. And that was the final vote, which squashed the effort to repeal and replace, or there were also terms of skinny ACA plans, which basically stripped the primary components from ACA. Long story short, those efforts failed. So that was 2017. So really, the original court case in 2012 plus the 17 scenario, that was 2 swings that were attempted to wipe out ACA. And here we are with the third swing. And this started in 2018. The bottom line is this all began when the Trump administration signed a tax bill which went into law in late 17. It was December of 17, a big tax bill. And part of that tax bill, you may recall, zeroed out the penalty for the individual mandate. So from a federal level, at that point, there was no penalty going forward for individuals for not maintaining adequate health coverage. And in line with that, there was a court case filed that said, because the penalty is now 0, we think the whole law should be invalidated. That's what started this 2018 court case. That case made its way to the Supreme Court. In fact, the Supreme Court heard arguments on that case 1 week after the most recent presidential election. So this was during the second week of November of 2020, just a few short months ago. The Supreme Court is expected to render its decision by sometime this spring, June at the latest. And if you really think about it, The expectation here, the likely scenario is that the ACA is upheld. That seems to be the most likely scenario. Another potential scenario is that the individual mandate, which is a zero penalty now, as I said, may be ruled unconstitutional, which for all practical purposes really has no effect on the way things stand today anyhow. And I think the third potential event, or the third least likely, I guess you say, is that the ACA is totally overturned. And I don't think that that's a likely scenario. That's very far-fetched. And the reason being is the tentacles of ACA are so embedded in our healthcare system at this point that would be beyond disruptive to many aspects of our way of living, beyond even health insurance. So that's where we stand now. We've had 3 challenges to ACA. Matt, as you said, ACA remains the law of the land. Mm-hmm. IRS enforcement efforts continue, and we're going to get into enforcement efforts in a moment. I'm going to pause here, Matt, and just pass it back to you just for a moment.
Yeah, thank you. We are starting to get some questions, so thank you for that, everyone. And if you're not familiar, find the Q&A button there and feel free to pass any questions along. But first, what I want to do is start with a quick poll question. I'd like to get some interaction with our group here, just to have an idea of how folks are currently using, or how folks are currently, utilizing technology or not to accomplish their ACA tasks. So you should see a poll coming up on your screen. Please take a quick second to give me a yes or a no, and then we're going to get to one of our questions. And this has to do with everybody's favorite topic. So back in 2015 or so, there was one way to do ACA reporting, and that was tracking everything in a bunch of spreadsheets. That's gradually gone away over the last 5-6 years for the better, but always still curious how many folks are working with a broker, just doing manual spreadsheets and such. So thank you much. I think we have the polls are in. It looks like about 2/3 to 1/3 of 2/3 are now up to not using spreadsheets. So good for you guys. I'll end the poll. And Todd, I got one more for you. And that is, you talking about law of the land and Supreme Court and all these federal things. What we're starting to hear more about, including here in our home state of California, is local equivalents, I think you'd call them, to ACA reporting. Can you speak to that a little bit? How do those, is this now, we're just going to double our pleasure here, or is it complementary? Can you talk a little bit about the local and individual state mandates starting to crop up?
Indeed, double the pleasure that's an interesting way to put it. So yes, what you saw is in 2017, when the individual mandate penalty was zeroed out by the tax bill, you saw the reaction of a number of states. In what they did is they implemented their own individual mandate at the state level. And as a result, in California, as you point out, is one of the states, these certain states are requiring reporting at the state level now. And 2020 reporting year happens to be the first year that California is in the loop. So that is definitely something to keep in mind for those employers who have operations in the California.
Okay, thank you. All right, we'll pass it back to you now.
Excellent. So, we talked about the law of the land, and I do want to spend a moment on this, gang, and this is really important. The penalties for non-compliance, the IRS is not lax in enforcing the ACA, and we have seen no relaxation of enforcement in the last year during COVID. In fact, I just got off a phone call about 40 minutes ago with an employer who just got a letter dated 2 days ago. And the letter is for a proposed $83,000 penalty. And this is really a small employer. They have 67 employees. And that letter they received was for 1 year. So the penalties are layered. Employers could be penalized for not offering adequate coverage to their full-time employees. They could be penalized for not furnishing 1095-C forms to their employees, or they could be penalized for not reporting ACA, not reporting the 1095-C forms to the IRS on an annual basis. So it's not just one penalty. Hey, I got this one penalty. There's different layers depending on where the failure lies. And these layers are looked at on an annual basis. I do want to share this. I mentioned this $83,000 phone call. Well, this year, this is one of the famous IRS letters. And you'll notice the penalty amount here on the screen, $1.4 million. The IRS is not playing games, and I show this not to scare any of our attendees, Matt, but rather to emphasize the fact that this is not something to be shooed at. If you are a large employer who should be reporting, you should really take those responsibilities seriously. The IRS has ways to track down employers. In fact, we're going to look at how the IRS does that. The IRS has 7 formal letters that they will kick out of their system. These are automated letters which are triggered by a number of employer characteristics, and I'll give you a couple of examples. One characteristic which may trigger an IRS letter is because of information that the employer supplied, that the employer furnished to the IRS when they reported its ACA filings. For example, they may have reported that the health plan did not meet certain minimum standards, or the health plan may not have been offered to all its full-time employees. So something like that would trigger a letter from the IRS. Something else that which may trigger a letter is information which is furnished by an employee to an online marketplace during an application for individual health insurance. So that could also trigger a letter. And then lastly, which was the letter that I happened to see today, is if an employer is not filing their ACA, but the IRS suspects that they may be an applicable large employer because of the number of W-2 forms which are filed for that employer, there's another letter, this letter here, which would be triggered. So the IRS has its ways and means. It's taking it seriously. It's full enforcement. It is the law of the land. Quite frankly, Matt, since we did our previous webinar a couple of years ago, nothing has changed. There's been a lot of chatter, but nothing has changed with respect to the employer responsibilities. And I'll pause again just for a moment, Matt, and pass it over to you.
No, thank you. I think, I don't know if you've actually clarified this, but we have gotten some questions just about the actual requirements. And so I might have you talk about, what is the ALE you've referred to, right? What is the applicable large employer? And then I have a follow-up question on that. So why don't you define the parameters real quick, Todd? It's pretty simple, I know, but I don't think we've actually stated that yet.
Yep. Yeah, because and naturally, that's the whole basis of who must report, right? The applicable large employer status. So this is, to simplify it, this would be an employer who employs 50 or more full-time employees on average in a given year. If you are such an employer, you're considered an applicable large employer, or ALE. And when you're considered an ALE, the IRS is expecting you to offer affordable minimum coverage to your employees, your full-time employees, and report on that coverage, meaning furnish a 1095-C form to the employees each year and report to the IRS on that offer of coverage. There's a few nuances with determining one's ALE status, which are worth noting here. And the first being the determination as to whether or not an organization is an ALE is determined by looking at the prior year. So for example, for the 2021 year, here we are in February, I should know if I'm an ALE as of January 1st of this year. And how do I know that? I know that because I'm evaluating the 12 months of 2020, the prior year, and I'm determining how many average employees I had for the year. How do I do that? Well, I pick a date. For example, I'm going to pick the 15th day of each month of 2020. I'm going to analyze how many employees I have on that day each month. So at the end of the year, I'll have 12 numeric values, one value for each month. I'll do the math and I'll come up with my average for the year. If that average is 50 or more, then I'm considered an ALE for the following year. Okay, and the IRS is expecting me to act accordingly as far as offering coverage and reporting for that following year. Something else that is worth noting is with the crazy year we've had last year with COVID, and we've seen this particularly impacting hospitality type organizations, retail organizations, and that is where there's a reduction of workforce. And organizations may have entered the 2020 year as an ALE. So on January 1st, pre-COVID, the organization was an ALE. And as the year progressed, there were layoffs, there were furloughs, and in many cases, the number of employees dropped below 50. And in some cases, there were no employees, and potentially even for the remainder part of the year, maybe April through the rest of the year. And it's important to understand that the IRS is still expecting those employers to report for the 2020 year because that employer was an ALE on January 1st and will continue to be an ALE for the duration of that 2020 year. Now for 2021, they may not be an ALE for this year, but certainly for 2020 in that example, the IRS is expecting reporting. Matt, does that make sense?
It does. Thank you. We have another question or two coming in on deadlines I want to get to, but I want to tackle another one as well. I'm deciphering a few questions here, guys, but the concept of multiple companies and versus a control group. I just touch on this. I know we can go down a rabbit hole here, but so the concept is I might have 3 or 4 different federal ID number companies, all with less than 50, but the total of all of those together is well over 100. Let's say I have 3 or 4 different companies at 30 employees each. How do the rules for ALE work there? It's something we run into a lot with payroll, because payroll, everything's separate. The FEINs are separate, the tax filing's separate, et cetera. But I know benefits, sometimes they aggregate those together as a control group.
Yeah, so the control group rules, if in your question, this employer seems to clearly recognize that they are part of a control group. It sounds like there's 3 entities or 3 EINs with
Correct.
common ownership. They operate with the same workforce or same management, same ownership, and so on. So the easy way to look at situations like that is you're grouping the entities together. So those 3 entities are grouped together. You're doing the math on full-time employees collectively, and you're determining collectively, in your example, 100 plus total. So that means individually, each of those 3 is considered an ALE, even though individually they may have fewer than 50. Collectively, they're over that number, so they are all thus considered an ALE, and they all thus are expected to report to the IRS.
Fantastic. I think I'm going to table some other ones until after the presentation and let you proceed with the show here.
Okay, cool. So we talked about the how to determine the ALE status, I thought we would also talk about, the information which is reported and why it's reported, and just to kind of simplify this. And really, ACA reporting could be complicated. If you're using spreadsheets, to Matt's poll earlier, if you're still doing it that way, it could be complicated, and you could be getting a lot of headaches doing it. The reality is it's really simple what the IRS is asking for. They are asking you as an employer, as an ALE, to identify your full-time employees and to report as to when you offered health insurance, whether or not that employee enrolled or waived, and how much the contribution is for that employee for this single tier of coverage. That's what the IRS wants to learn about. And by reporting that to the IRS, you're also furnishing that information to the employee. Now, if you think about it, it's not news to the employee. The employee knows they were offered insurance. This is not a form which must be filed with an individual's tax return. This is informational reporting for the employee, and it's also informational reporting for the IRS. And this reporting helps the IRS enforce the ACA guidelines. Specifically, it allows the IRS to determine which ALEs may be subject for a penalty for non-compliance, either not offering adequate health insurance, not offering affordable health insurance, or not offering insurance at all. So that's what this reporting is all about. The form looks very simple here, the 1095-C form, and it really is a simple form as far as, hey, name, rank, serial number. Where it gets complicated are the indicator codes down here, and that's where Payroll Systems comes into play to simplify it. So that's the reporting to the IRS. Matt, I'm going to pause another moment.
No problem. Thank you, because we are getting some questions coming in. The topic of deadlines has come up a little bit, and basically there's not just one deadline. Correct me if I'm wrong. There's maybe a deadline for different events happening with different dates, and in the years past, those have gotten pushed out. Can you go through real quickly the deadlines for 2021? And then it sounds like we actually have a Nimble client on the line here as well, who says that the 1095-Cs are sent to the staff directly, but how do they validate that? How do they know that it has happened in order to complete the ACA filings for an existing client using your technology? So go over the deadlines and how do we validate that it actually happened? Todd, not sure if you've muted or not, but I can't hear you right now.
Oh, there we go.
There you go.
Let's hit the validation first, Matt. The client will see an IRS receipt ID, which I'm expecting will be published, I hear, the first week of March, directly to the Payroll Systems portal. So the client will see that receipt ID of filing. That's their confirmation.
Got it.
As far as dates go, there's a couple of dates to keep in mind. The first being the date in which the IRS is expecting us to furnish the 1095-C forms to employees. And that's this date here, that's next Tuesday. And those forms must be hand delivered or postmarked by that date. So if you get them in the mail by Tuesday, you're timely. The IRS considers that acceptable. So that's the first timeline to consider. And incidentally, that timeline has been extended every single reporting year. The reporting year, the ACA reporting began in the year 2015. And each and every year, the IRS has extended that deadline, the distribution deadline, from January 31st to March 2nd. They've basically given a 30-day extension every year. So that's our first deadline. That's next Tuesday. Then the second deadline is the actual filing with the IRS. We do everything through the payroll systems in an e-filing fashion. So the deadline for e-filing is a month from now. It's March 30th. So those are the important dates to keep in mind. Does that make sense?
It sure does. Thank you. And again, all dates readily available as well. Follow-up question came up on this concept of a look back period. And if you could give a quick explanation of what the calculation is for look back periods.
Indeed, yes. So the IRS, actually, let's pull up an article on this. This is actually a good segue here. We'll just kind of have this on the screen here for our attendees to peek at as I'm explaining this. So for ACA purposes, the IRS is expecting the offer of health insurance to an employee who is full-time, and a full-time employee can be one who is designated full-time by the employer, and that simply means that that individual, when hired, is expected to work 30 or more hours per week. Many times, maybe it's a salaried employee, management type of employee. Some organizations only have full-time employees. I know in our office, everyone here is full-time. So for some industries, that's all you'll have are full-time employees, designated full-time employees. Those employees should be offered insurance after the health plan waiting period, and that would be 30, 60, 90 days from employment. That's pretty simple. Your question, Matt, on look-back periods, that would apply to all other employees, and let's call those employees part-time or variable hour employees. These are employees who, when hired, the employer cannot make a reasonable determination as to whether or not that employee will average 30 or more hours per week during their period of employment with the employer. And as such, because we don't know if they'll be benefit eligible, we are not obligated to offer insurance to these part-time employees after the waiting period. Instead, we can use this measurement period, and the IRS allows us to measure the hours of these employees over a three being the minimum, 3 to 12-month period. And we can evaluate hours during that measurement period, and we are not obligated to offer insurance during that measurement period. And only after that measurement period, if that employee satisfied the average hours threshold, the threshold being 30 hours, would we be obligated to offer insurance at that point. So we see measurement periods typically of 12 months. That would be the most common. That's the simplest way to establish your measurement or look back periods. And we see shorter periods, but 12 is the typical length of time.
Great. Thank you.
You are welcome. We're going to segue. Let's talk about, let's refer back to our agenda here. Let's kind of jump over here. So we talked about the ALE, how we determine the ALE. Again, we look back to that prior year. We explained this, what the IRS is expecting as far as why we're reporting and what we're reporting. And Matt, you had just asked about the look back and measurement periods. I'd like to talk about the best practice tips. And there's really, I would say these are probably the 5 nuggets, if you will, for employers. And let's take a peek at these. So again, ACA could be complicated if you're using spreadsheets, if you're waiting to the so-called ACA season, as Matt described earlier. That's really the harder way, the more challenging way to manage ACA. So one of the tips that and this is number 1 on every list that we talk about as far as best practice tips, is remember that ACA is a year-long process. The reporting is for each month of the year. So we're reporting for January through December. So therefore, I'm going to spend some time as an employer each and every month. I'm going to spend just a few minutes every month, and I'm going to manage that process as I go along. So if I'm able to do that, I'm able to manage January, February, and so on. By the time the end of the year comes, I have no ACA season. There's no headaches. I'm caught up, I'm complete, and I can move on and operate my business. The second tip is ensuring your payroll data is accurate. Specifically, I just talked about full-time and part-time employees, making sure those designations are accurate, making sure addresses are accurate, hire dates, term dates. All of these things pre-ACA may not have been so critical. They're critical all the time because of payroll, but you really want to be spot on and make sure that data is accurate. Also, Matt, you asked about the measurement periods. These data points affect the measurement periods and the waiting periods. So making sure your data is accurate, that would be number 2 best practice tip. Number 3 is document your decisions. There's a lot of moving parts with benefits, specifically when ACA is thrown in the mix. You've got payroll, health plans, ACA reporting. So make sure your organization is documenting what is the health plan waiting period. Is it different for different classes of employees? What are we using for our measurement period length? And make sure anybody on your team understands what those decisions are. So that, keep a logbook. Document your decisions, number 3. Number 4, we showed that IRS letter, the $1.5 million letter. This sounds very simple, but I've seen it many times. Make sure your key personnel know and understand potentially what can be delivered in the mail. This is not junk mail. This is real mail. We've had situations where employers have been penalized or proposed penalties because they didn't respond to these letters. They claim they never received the letters. So whoever's handling mail in a given office, and Matt, forgive me, I know this sounds silly, make sure they understand. There's letters which come from Covered California. There's letters which come from the DOL and the IRS, and these could be ACA related. It's not junk mail. Make sure you get the letters, respond to them timely. Typically within 30 days is the requirement. And lastly, training your team. Whoever has hands-on with payroll, benefits, and ACA should be trained on the basics. There's no need to be an expert with ACA. If you take care of a few of the basics, which are making sure your payroll data is accurate, we talked about understanding the basics of the health plan, then you just need a basic understanding of how the Payroll Systems ACA platform works, and you're rolling. So make sure those individuals are trained properly. So those would be the best practice tips, and simple as they may sound, if executed, you really will be spending just a few minutes each month managing what could be a crazy ACA process.
Yes,
Matt, I'm going to swing it back to you.
No problem. We have lived through several years of crazy ACA process. Yeah, I'd like to launch another quick poll, just specifically talking about time. Really curious for everybody to spend just a quick second to click the appropriate box on what your current ACA process does look like, specifically in terms of time. So take a look here, and please give us the appropriate action. How much time, and is this a year-long process or is this a January process? What are you doing now? And thank you, everybody's coming in. It's actually looking pretty even so far across the board. Give it just a couple more seconds. Looks like spending a bunch of time in January does seem to be the majority process right now. So thank you for that. It's probably, I assume, same folks using spreadsheets. And again, there might be other options we can discuss. So thanks for that. I'm going to close the poll, and Todd, I'll let you proceed on. We have a few more minutes, but I would like to leave certainly some time available for Q&A at the end. So maybe try to get through your last slide or two here in the next 5 minutes would be great.
Yeah, well, I think we hit the meat of the presentation. We do have some time, Matt. I think that would be great if we can handle some questions. Why don't we go ahead and do that?
Yeah, you got it. So first of all, obviously we put the contact information up on the screen. If you would rather shoot a quick email to either Payroll Systems or directly to Todd at Nimble, he's graciously posted his contact information there and is happy to answer questions down the road. I have one or two more on my plate here. So first of all, the concept of a self-insured employer has come up, and I don't know if that's something you want to tackle now or we can dig and get more information, but question reads like this. I read that if you are a self-insured employer with less than 50 employees, you may also have to report. Is that true? And can you explain the requirements more? And having to do with self-insured employers.
Yes. So that's a good question. So in that scenario, if it's a employer which is not considered an ALE, this is the large employer at 50 or more. In this case, it sounds like this is an employer with fewer than 50 employees, so not an ALE.
Correct.
This employer would not be subject to the ACA offering penalties. In other words, they're not required to offer affordable coverage. However, if this employer offers coverage which is self-insured, as the question states, then that employer is obligated to report on those employees who enrolled and dependents. And that form is similar to the 1095-C, Matt. It's the 1095-B as in boy. Slightly different flavor of form, but yes, that employer is expected to report on the covered employees. And incidentally, it's a distinction because if the employer is an ALE, the employer, and let's assume a self-insured plan with an ALE, the employer is expected to report not only on those employees who are enrolled, but also all other employees who were offered coverage but waived. So there's a little distinction as to what's being reported and the number of employees as well, whether you're large or small. Hope that makes sense.
Yep. Gotcha. Okay. And a couple folks have asked about getting the slides or a recording. So a couple of things here. The recording, the webinar is being recorded. We will have that posted probably late today or by tomorrow at the latest. And all attendees will receive an email with a link to the recording. So that should be on your inbox. You feel free to share that within your organization as you wish. As far as getting a copy of the slides, we're happy to do that. Send an email to that email info@payroll-us.com. We're happy to get you out a copy of the presentation itself, the actual slides. Okay. And last question, or a question just came in. ALE, does it specifically pertain to headcount? The answer is yes. So ALE specifically talks about full-time equivalent employees. Taking, and from either manually tracking yourself or certainly in the payroll software, we frequently do census counts to get you an ALE count or a full-time equivalent count rather. Okay, did you want to share some links and then we can wrap up here? We're right on time.
Yep, these are in the slides, Matt. So as you furnish these slides, some of the articles that we went through, which by the way are always available to users of the Payroll Systems ACA platform. We were in the live platform navigating through those articles, and those links are furnished here in the back of the slides.
Well, good deal. I think go ahead and put the contact information back up again. We have a request to do for that. We'll leave this on the screen for just another minute or two, and then we're going to conclude the webinar. So Todd, I'll just take a quick second here to say thank you. Appreciate your preparation on putting this together. Appreciate you taking the time today to share, and appreciate you being willing to follow up with our audience for questions in the future. So especially, I'm sure you're in the middle of a busy ACA season yourself.
Our pleasure, Matt. Thank you.
Like I said, we'll leave this up for just another minute, and then we'll conclude the webinar. Thank you, everybody, for attending. Feel free to follow up with phone calls, questions via email, and we look forward to everybody not receiving any ACA penalties for this year or next year.